First of all, by way of introduction, this panel is targeted as being focused on collateral practicalities. So we've heard some of the general principles about clearing. Now we want to turn to the plumbing. And so you can think about with all of these regulations, it's a bit like, if I pursue the plumbing analogy, a bit like building regs, except we've got an awful lot of building regs all coming at once. One of the advantages that at Rule Financial we have is we end up working as consultants with the sell-side firms, the buy-side firms, the custodians, and the CCPs. So we get to see this from all different angles, and I can confirm it is complicated. We have a great panel here today. Let me introduce them. On my left, Ido, Head of Treasury and Client Portfolio Management for PGGM, representing buy-side. Rich Hochreutner, Head of Global Collateral and Director of Group Treasury for Swiss Re, buy-side. Greg, Managing Director and Global Head of Fixed Income for Citibank, sell-side. And Chris Redmond, Manager of Securities Settlement, Supervision and Policy from Bank of England. So we have a central bank. Chris, let me start with you. How thankful we all are that the central bank's going to bail out the CCPs. Phew. Would you like to comment?
Yeah, I'm looking forward to bringing back Godfrey's message to the governor. Thanks, Godfrey, for volunteering us and the British taxpayer. That's really nice of you. I think it's really topical, though, because I don't know how many of you have follow very closely what Mark Carney says. I certainly do. But he did make some pretty loud noises in this area in terms of the Mansion House speech that he recently gave. Now, one of the first things I would say is I would pick up on Marcus's point that he made in response to Godfrey. You got to look at what happens before you get that far to where the CCP starts to get where it might be into trouble. So we've got to look at the big picture. We've got to look at the overall regulatory framework. And we've got to see how that works. Now, one of the things the governor said in that speech, I urge you to read it. It's very good. One of the
you
things
didn't write it, did you?
No, I didn't write it, but I'm going for brownie points here. No, one of the things he said here was that you've got to look at the regulatory framework and you've got to see that we have made banks more robust. But something that end users may not quite understand yet is that the risks have now been more distributed throughout the system. So that's one of the things you've got to look at. I think the other thing that's interesting here is that the bank is at the cutting edge of looking at these problems. And the governor made the point of looking at what do core markets need. And we've now been looking to, do we need to extend liquidity insurance to non-banks? And he made an announcement around the big broker-dealers and the CCPs. Now, those terms will need to be worked out. The details of those will have to come forward in time, but that's quite a large step forward. Obviously, it's for other central banks to make their decisions on that. The other missing piece is actually, Godfrey is absolutely right, is what do we do when it does come to recovery and resolution of a non-bank? We need to plan for it. It might not happen, but we need to be prepared. And so I think this is something where the European Commission is going to be able to come forward on the basis of international work, and we would hope to see this in their agenda for the next Commission.
I guess a key question as well that arose from the previous panel is, are CCPs too big to fail? Many might have seen the article in the Financial Times a couple of days ago, implying that yes, they are, so it'd be interesting to get people's views anyway. But the consequences are, if they are too big to fail, then there are two possible outcomes. One is that they require official support from central banks, or the other is that they should be allowed to fail. What's your view on that?
I think we should look to see what the international agenda puts out in terms of recommendations, and we should look to see how the resolution directive comes out, or maybe a regulation, the legislation develops in that area. Certainly, the overall drive has not been to put taxpayers on the hook. We are looking for recovery and resolution. That's the prime thing here. Taxpayers should not be on the hook.
Should have been a politician, man. You're wasted as a regulator. I don't think any politician could have parried that question better. No, what I would say on that is the two things are not mutually exclusive. It's not either or. I think like with any institution, and in fact, many of us in this room would be in the same category in politicians' and regulators' eyes as the non-bank institutions that you're talking about. I think they will probably end up benefiting from some official support. I simply, given the size and complexity that these institutions are assuming and the central role that they're playing in our financial system infrastructure, they're becoming rather two important nodes in our infrastructure. I cannot see a scenario in which they will not ultimately benefit from either explicit or implied official support, and I would be quite willing to bet that it will be explicit at some point. But I don't think that will mean that they will not be allowed to fail. I think that it will be, the official support will be probably a step in the process of an orderly liquidation, recovery and resolution process, basically. And I think that is right and proper, because you need to protect the system as a whole, but you also need to remove as much of the moral hazard as you possibly can and ensure that the system operates as it should, basically, and not as a cowboy saloon, which it will if you ultimately have someone who is absolutely deemed as too big to fail and will be saved at all costs.
Let's talk about the system as a whole then. We've spoken so far about the CCP, but of course that's one part, one actor in the overall system. And Citibank, as a sell-side firm, you're sitting between CCPs and your clients, the buy side. So how do you see all of these different regulations? So the CSD, EMIR, Dodd-Frank, Basel III, MiFID. How are all these going to fit together? Are they going to fit together? And when?
Well,
You've got 3 hours for that.
I would need at least 3 hours to discuss this question in depth. What I will tell you is that I think that by definition, almost ultimately, they will fit together. But why am I saying this? I think that the regulatory process is an iterative process. I know it doesn't feel that way right now, but I'm seeing how the sausage is made every day, basically, and it is an iterative process, whether we believe it or not. I think that as it is today, all this slew of regulations that is coming out and hitting the market, all of which is well-intentioned, I would say, but not necessarily all of which is well-aimed, they don't fit together, in my view, today. There are conflicting demands from regulations, and there are parts of the regulatory community that are not necessarily communicating as well as they do with other parts to make sure that it all fits together in one grand master plan. Basically, there is no grand master plan. But I think that regulators are smart people. I think when they see the inefficiencies that they introduce, when they see how the system does not fit together, they have shown themselves to be sufficiently flexible to actually change it to a more intelligent design. So, and because the system ultimately will not be able to function if it is not functioning to an intelligent design, or will function in a very inefficient way, and without wanting to sound like a rabbit market theorist, I really do believe that systems tend to gravitate towards the most efficient operating models. That comes from my engineering background, I apologize. But I think that ultimately, because of these two immutable laws, if you wish, I think that we will end up with a model that fits together. It will just take a few iterations, and it could be actually several years. And we may have to go through periods where things are actually dysfunctional to some extent and have to be seen to be dysfunctional before we will make the changes that are necessary to make the system fit together.
Can I come in on that, actually? To give the regulatory viewpoint on that, I think it's always, again, useful to step back and ask, why did this happen? And, people say, well, the regulatory framework, doesn't feel coherent enough. Well, the crisis wasn't coherent.
Exactly.
And what you have then is a mass of different regulations and legislation and actions and reactions. And so I would agree, this is going to take some time to work through. It's going to be difficult to tell what the implications of it all is, probably for a couple of years. And then, yes, it will be iterative. But the point is, we have taken action and we have already made the system safer. It's just a question of how do we make the moving parts work together better. And that will, I think you're absolutely right, depend on getting the evidence of what works and what doesn't work. And I think, this is where, for example, transparency is a very important thing, so that we can actually see how markets work, especially, for example, in terms of securities financing transactions.
Let's turn to the implications for collateral of all of this, and the beneficiaries of lower risk and the recipients of higher costs of all this, the buy side. So let me invite Ido and Rich to comment on what does all this mean for collateral, all the way to these regs. How does that impact you?
Well, there can be a huge impact. If we step back to the previous panel, they ended with the question, are we in a safer world? And I thought about that question myself. And I think clearing has the potential to make it safer, but I don't think we're there yet. There are two main things, I think, which makes it not safer yet. First of all, because it's made mandatory. A lot of end users are forced to clearing, where we're still building a framework to make it safe, which sounds not very right to do it already. And the second thing is, what's also an issue for pension funds and other long-only investors, is that you actually have triple B or single A companies guaranteeing you to the to the CCP. I would be more comfortable if a triple A or double A rated institution would guarantee me, and would be much safer. And as long as we're not there yet, I think there's still ways to make the system safer. Collateral is all about liquidity and the movement of collateral. And that's also where I think that all the regulation, especially the capital requirements for banks, or the liquidity requirements for banks. You see banks retreating from repo markets or fixed income markets as a liquidity provider. They're more worried about their own balance sheet and their own liquidity ratios than to be a market maker in the market and to fulfill this role as market maker. And that's one of my main worries, that collateral will be not as fluid as it should be, as is assumed probably by the regulator when designing this framework. So I think the fluidity of collateral will be the big theme for the coming years, and I think it will, we have to have more participants maybe to this repo market or the short-term funding markets. And that's one of my main worries, that we already see now, currently with low interest rates, we receive a lot of cash, but it's actually becoming a hot potato, as I said yesterday. We found it's harder for us to find counterparties to actually willing to accept that cash and to do reverse repos with us. So that's, I think, one of the main threats to the system currently.
Rich, you want to pick up the points about cash versus non-cash collateral?
Well, actually, I'd like to pick up something else, if I may. I'd like to pick up the fact that I debate whether the thing is really getting safer right now based on the initiatives that have been taken. I think the market is a lot safer than it used to be, but just because people have started to do their homework. And I think that every single organization has to obviously look at their risk appetite and how they quantify risk and how they measure risk, how they monitor it and how they limit it. And I think the regulatory side is very frequently, as you pointed out, I think very eloquently before, well meant, but has not really coming together yet. And I think that some of the things will actually have exactly the adverse impact, that will actually increase risk, so much to your point, where if there's less market participants willing or able to continue to participate, I mean, particularly for buy-side firms, if these extreme balance sheet pressure carries on with for some of the banking community, it doesn't really benefit us to be able to actually execute in the market if there's nobody able to deal in the size or in the diversity we would like to be able to do. Diversity, the other thing I wanted to say, is that I think the insurance industry, as well as the banking industry, likes diversification of risk. And here we are running into central counterparties, which is exactly the wrong direction. And I think, and I have said this before, and I will not leave this opportunity out, and we're not fans of CCP at Swiss Re, for whatever product they may be. It ends up, and I think if we're talking about having ultimately potential backing by the, let's say, the official side, we're actually back to socializing the risk again, whether we want that or not. Now, what is the benefit of having a bank which is too big to fail over a CCP which is too big to fail? Ultimately, as a taxpayer, you're paying money in the case something going wrong. I think and really looking hard, I think the only advantage that I can see in a CCP is that it would be so extremely highly regulated and so prohibitive that you would hope that it would be safer than, I think somebody used the word cowboy before, that any potential cowboy institution, there's a lot more people looking at them. So potentially there's less absolute risk at the end. But the socialization aspect is exactly where we didn't want to go. But I understand it has to be there. And I think that's the conundrum which hasn't really been sorted out yet, in my mind.
There's been lots of talk over the last couple of years about shortage in collateral to meet the requirements of all these new regulations. And I'd like to put our first audience question up, please. So I'd like to get people's view here about when there'll be a shortage of collateral. So clearly there's an assumption there, implied assumption. So do you think we're already there? Do you think as mandatory clearing kicks in during the course of early 2015, throughout that year, and the collateralization of the uncleared by December 2015, so do you think it's end of 2015? Is that when we're going to hit the shortage? Or is it going to be further out from that? Or actually, do you think it's not a problem, it's never going to happen? Please place your votes. Never going to happen.
It's a shame.
Then I can't quite see those numbers. 22% by the end of 15, by the end of 16, a few by the end of 15, and 6% saying we already have a shortage. Interesting.
I was sort of somewhere toying before the blue line and the violet line, if my colour blindness doesn't cheat me here. I think that for it to be never, I think that a lot has to happen. I think the governments are doing a great job, so there's a lot more collateral coming to the market, so that's great. I think that what we all as firms need to do, though, is to really buckle up and break down silos within our organizations to actually have central collateral management. And I might be stating the obvious here, but there's still a lot of people which have an equity finance and a fixed income finance instead of having a securities finance. There are still a lot of people which will have an OTC derivative group, and then they'll have a securities lending group, and there will be other people worrying about other forms of collateral. And I think for us to not have a shortage, I think it's very important, and I know there's been papers issued by your fine bank to encourage this, but we really need to take this seriously. We need to go out there, invest in infrastructure in our organizations to bring collateral onto one platform, and that will help make this picture with the high never actually become reality. If we don't do that, I'm not convinced. And I think your point about the fluidity before is absolutely key.
I think I probably agree with the audience that on a macro level, you probably won't see a shortfall. In general, there's enough collateral around. And possibly you see also a lot of people retreating from the derivatives market. So I think in the US we've seen that the actual initial margin posted by end users is only $40 billion or something. So much less than expected. So probably on the total level, no collateral shortfall, but on an individual level, there certainly can be collateral shortfalls. And it's also dependent how you define the term shortfall, because it probably is also a cost thing. You can still have collateral, but if it's very expensive to get it and to post it, it's maybe not a shortfall, but it's really a cost burden. So again, it's all about, I think, moving the collateral quick enough and to get it at the right places. That's coming back to it again, breaking down the silos and all those kind of terms. At PDGM we already started, I think 5 years ago, not with this future picture, but already doing sec lending, repo, OTC collateral management out of one place. And, I feel very lucky that we took that decision then, because it's now proved very fruitful, but still, even then it's very hard to have this silo torn apart, because the infrastructure behind it is still very siloed. There are different parties to the game, there are different collateral management, different custodians, different CSDs, etc., etc. So it's still a long way ahead. Exactly. But
exactly, and that is a key point, because see, I think almost by definition there will not be a collateral shortage for two reasons. A, because there is, A, enough collateral around, but B, because the market will reprice to a certain level where there will be sufficient demand distraction if it gets too expensive that it will get the system to balance. That's not necessarily what we want, because that actually introduces new risks to the system. When derivatives transactions that have a legitimate economic hedging purpose do not happen because it is too expensive from a collateral point of view to do the derivatives transaction, then you're introducing risk in the system which the regulators, not least, as well as ourselves as an industry, should and will definitely be unhappy about. So the fact that there's not going to be a collateral shortage because the market will clear is actually not the right question to be asking. I think that the way we need to think about it is at which level is there sufficient collateral priced well enough to allow all economically necessary hedging transactions to happen and to be hedged and cleared efficiently, effectively, and cheaply enough. This is the point that we need to answer. And for that, because of the costs, on-balance sheet costs, and other costs that are being imposed on the main intermediary community, which is the banks, so far, up until this point in time, the banks have been the main intermediary community. The costs that are being imposed on us now are making it extremely expensive for us to provide this service to the market. Because of that, we need to have a great squeeze in other costs, okay? And I noticed earlier on the first question, which was basically, what is the composition of the audience? 24% of you are service providers. You're going to need to think very carefully about your cost structures, because your cost structures are becoming extremely important to us. You may think that it's only a few pennies, right, in a transaction. But when you look at the capital costs of our balance sheet, for example, and when you look at how many steps, to Ido's point, how many steps in the process we need to engage in order to move collateral through the system, it becomes an extremely important part of the equation. So the efficiency of the system, how efficient you are and how efficient the system is designed as a whole, meaning how few steps we have in the system, is very important.
Can I just say one thing there, Greg?
Yeah.
When you say steps, that would also include the limitations rumoured for rehypothecation.
Absolutely.
So if you can only rehypothecate once, for example, that would be, I think, detrimental to collateral supplies. But sorry, I just...
It will be, although that's a fact, right, for
Yeah.
effectively for large parts of derivatives clearing today.
Yes.
That's already been passed. And, we can talk about it separately, right? But talking about the infrastructure, the design flow of the infrastructure and the cost of the individual components of the infrastructure are extremely important, and it's something that you will have to think of very hard if we're going to have a system that clears at an economically sensible level.
I think that's interesting. I mean, it's a classic case of one man's inefficiency is another man's revenue flow, right? And I think the key problem here, is I agree very much with what I'm hearing, is fragmentation is the enemy in this situation. I mean, it's this classic example again of there's enough food in the world, but we still got starvation because the food isn't where you need it when you need it. It's a similar situation. So the infrastructure is absolutely key. And I would completely agree, we need to start within an institution first and branch out and look at wherever fragmentation exists, because we do need assets to be able to get to where they're needed when they are needed as collateral. That is the challenge, and the evolution of that infrastructure and the evolution of market practices, as you're saying, if banks are coming out of this, that intermediary role, how will the market evolve? And the market will evolve, of course. And it's just a question of how is it going to happen. And again, I think this is where the interplay will happen between the regulation, the iterative process, and the way that market participants act and react to that.
Chris, if I may, I'd like to invite you to build on that point about liquidity and in a future state of when the infrastructure of the industry has evolved a little further, to make everything really efficient, to allow collateral to flow. You hear this phrase bandied around, velocity of collateral. Then could you describe to us how the industry would like to see its end state? I'm thinking in particular of the impact of the EMIR regulations, assets sitting in custodians that in the future a much greater percentage will be required to be pledged as collateral. And how should the infrastructure look in order to enable that collateral to be able to be reallocated between the asset manager via or perhaps indirectly bypassing the clearing broker to the CCP without having to have huge volumes of securities moving around the industry? And I'm thinking in particular, perhaps you could dwell on the famous article of EMIR 47.3, which has an unexpected consequence for where assets need to be located.
I think that's an interesting one. I mean, it's something that we weren't really, I don't think anybody was quite expecting the change in the market landscape, and it's evolving already as a result of 47.3. If you're not familiar with it, it effectively means that a CCP must hold its assets and the assets or collateral of its clients in a security settlement system. Now, this all stems from the protections that come from the settlement finality directive in the case of the insolvency of that intermediary. So the idea is therefore the assets that are held there are safer. Now, what the effect of this has been, it's been massive, because of course now we're seeing, for example, BNY Mellon has now moved to become a CSD, or to have a CSD. We have seen JP Morgan move to ally itself with the new LSE CSD, GlobeSettle. Now, the playing field seems to have been rebalanced in favour of this age-old battle between custodians and CSDs and ICSDs. But I think that this is going to change again, because the picture is not yet complete. Because we have to remember Target 2 securities. We have to remember that the settlement fees will not necessarily be there for the Euro system or participating CSD. So they will have to look, for example, at collateral management as that revenue driver for them. What will that mean? What will the eventual form of the CSDR mean? Because there will be additional requirements on CSDs. So that picture is not yet complete. I think where we need to get is an as efficient as possible situation, and that is, we need to then, like I said, we need to think about the fragmentation. Fragmentation comes in many forms, whether it's IT, operational, it could be legal. There's going to be a lot more cross-border transactions. You're going to want to use your assets wherever they are. You're going to want to be able to engage in a securities loan or a repo, regardless of where those assets are held. How do you know those assets are there? Do you have real-time visibility? Do you need real-time visibility? Who is going to execute that transaction? How is it going to be settled? All of these questions, I think, are going to need to be worked through in the next 4 years.
And if we turn to implications for the repo and stock lend community, if we think about assets sitting with the asset managers, those that are sitting on long, high-quality liquid assets, HQLA, the new acronym we're learning to use, there's been a lot of talk on conferences last year about collateral upgrades, but I'm hearing more and more about the collateral downgrade trade. Those that are sitting long HQLA, what revenue opportunities are there for the buy side in using your collateral to get to the places where other people need it?
Yeah, I think for a pension fund they will be very limited because of all this new regulation. We need to post in the future large amounts of initial margins, and basically we need our high quality assets ourselves. That's basically the message. Actually, I think we're going to be on the other side of the story, that we actually look at, for example, our sec lending business as a way to generate extra high quality collateral by lending out our stocks and getting bonds in return. That's one thing, we need it ourselves. And the other thing is, because I think liquidity risk is probably the biggest new risk for a pension fund. It's long only, so it can never go bankrupt theoretically, but it can have liquidity issues, that we can't sell our assets quick enough to cope with all the margin calls we get. So lending out our liquid, high quality assets is sort of counterintuitive to do, especially when you look at the premiums you get nowadays for those things. I talk to people, you offer me basis points, I want percentages, and then that's maybe also something what Greg said. It's all about pricing and getting the right price for the risk you're running. So currently, I have to disappoint people in the audience. They say, "Oh, we go to pension fund to get hold of our of collateral." That's probably we're on the other side. We're on the same side of the table, basically, in that negotiation.
So I would need to say, come to insurance companies in that case, because we still have some left. Now, I think that for our business, having this collateral transformation market is actually quite attractive, because on the one hand, I think what we at Swiss Re are probably on both sides of the market. It depends what currency we're actually there. So net, we're by far sellers of upgrade trades, so we have people coming to us, and I think that if we look at the yield enhancement that we can generate with collateral upgrade transactions and put that in proportion to the yield on the government bonds we have, it's a great trade. The increase in yield that you can generate is I think, very attractive. And I agree, it's not in the percentage, but neither are the yields in the government bonds really in percentages these days either. So,
but that's exactly the point. That's why we keep the buffer as low as possible, what we need for our own liquidity measures, where we're not going to buy bonds because they're so high yielding.
But at the same time, right, maybe in other currencies, we're actually very happy to buy the upgrade trade, because it's more worthwhile for us to be maybe holding corporate bonds, because the yield pickup is a little bit higher, and the cost for us to then, even with cross-currency in governments, to actually get the bonds we need then for a particular collateral deliver. So I think as a beneficial owner, you have a limited amount of supply, so the more people looking for what you have, fantastic, providing you don't need it all for yourself. But the fact that there's a market there enables you then to be on both sides and to actually transform that. And I think that's a part of what we all need to do to create this fluidity in collateral and to have those going backwards and forwards like that. So I like it.
Exactly, and that is the key point, in that it's not, what's the opportunity on the downgrade trade versus the upgrade trade, etc. They're two sides of the same trade, right? As my wife says, a man's upgrade trade is a woman's downgrade trade. So, you have both trades in the same transaction. Joking apart, right? So, the thing is that you have to be able to do both, because you will need, by the way, to do both at different times. At different times in the settlement cycle, in the hedging cycle, in everything that you do, right? And we, for example, on the sell side, we're well used to doing both. We've been doing upgrade and downgrade trades for years. We've been doing it for financing our books. We've been doing it for positioning collateral. We've been doing it for all sorts of reasons, right? To service our customers and so on and so forth. And they're not unlinked. They're linked. And so if you have a comprehensive collateral management system with real-time information, with the ability to move your collateral to where you need it, you will almost by definition find yourself doing both trades at different times, perhaps, or even sometimes at the same time as an intermediary. Now, the thing is, the market will ultimately price, as I said earlier, at a level that makes sense. So to Ido's point, you may be getting paid a few basis points now. I think that's going to change. The more collateral demand there is, the more the supply-demand dynamics will adjust as a function of the price of that collateral. And that will be dynamic through the cycle, and it will ultimately, I guess, trend upwards and plateau at a certain point from where we are now. But when it does plateau, I think it will oscillate as supply and demand dynamics change. And we see that today in the financing markets, right? It is no different. The financing markets are really collateral markets, right? Our product, securities lending, repo, all the transactions that we do are simply a mechanism for balancing cash and collateral. Okay, now all we're talking about is, instead of balancing cash and collateral as a treasury and risk management function tool, if you wish, we're talking about balancing collateral versus collateral. So, it will, as the demands for different types of collateral change, so will that pricing adjust.
Can I come in very quickly, give a regulatory perspective on that? I think the most important thing I could say here is we want these markets. We want these markets to work. We want them to be robust. We want them to be resilient. We want them to be efficient. And we want them to be there when they're needed, because that's what's going to ultimately keep the system going. And we certainly don't want to be the market. We want the private market to work. I think what's interesting in terms of the collateral transformation question is transparency and making sure that all of these trades will, from a regulatory perspective, they will generate interconnections. They will, we need to be able to see those interconnections, and we need to understand about where the risk is in the system. I think that's where the FSB shadow banking work stream will be particularly helpful. I think that's where, for example, the new SFTR legislation from the European Commission is going to be extremely helpful. And we also have to think about making sure that the counterparty credit risk and the collateral risk itself is properly priced in those trades as well. So those the FSB agenda will be very, very important for that.
I agree with you to a certain point, and I'm a total fan of
I'll take that,
transparency.
by the way.
No, I think I'm a total fan of transparency because I think as an industry we do a very bad job at explaining to people outside the industry what we actually do. And the most answers you get, so you're creating securities? No, we're not. It's the same securities, we're just moving them from A to B. So I think the more transparency we can provide, the better it'll be for everybody involved. We'll have less journalism probably on some topics where it's great to make a story where there isn't one, and we'll just have a boring business, which is essentially what we do. Save yesterday evening's party, obviously. But I think that the point where I'm a little bit cautious is when you say where we need to make sure we, the regulators, that the risk is being priced appropriately. That's, in my mind, meddling in commercial interests. And I think that's where it just goes too far. I think the transparency, making sure that that transparency can aid identifying systemic risks, but getting in pricing, I'm less a fan.
Yeah, I think probably what you meant is the risk is understood appropriately, right? The pricing is to the individual participants, but they need to understand what they're getting into. And as a system as a whole, we need to understand what risks are running where.
If that's a statement,
that's
I agree
that's
as well.
first. But
Otherwise
at
not.
the same time, there's also the question of haircuts. And the haircuts, minimum haircuts, will be something that will come through, and those are very important.
Yeah, and that is part of the risk management. Actually, to this point, if I can bridge the two of you sitting in the middle, I would like to pick on a point that you made earlier, and that is that we are designing a system which in trying to take out risk is introducing perhaps more risk, right? What I would say is the following, that we have just been through a near-death experience, and you all know what kind of a near-death experience it was, how close we came to basically blowing the whole thing up. So at the moment, all of us are extremely risk-aware. The market as a whole is very risk-aware. Sure, you may find the occasional, crack-smoking guy in there, but generally, everybody is extremely risk-aware. What is being designed now is a system for the next 20 years. I can assure you that in 20 years, probably people will not be as risk aware, and I think that is your point, that you want to have things in there that price the risk properly, because a generation from now, people will have forgotten this near-death experience. Frankly, sooner than a generation from now, they will have forgotten this near-death experience, because we are known for a very short-term memory. And therefore, we want to make sure that we have a system that will not breed the next round of problems, or at least we'll have sufficient safeguards in there to not breed the next round of problems.
In, right?
And that's where the transparency comes in.
That value.
Yeah. Exactly. Yeah. So this is the thing what we're talking about. How do we design a system that will not blow up in the future because we have become less risk aware and more complacent because we've gone through a sufficiently long period of low volatility and no blow-ups that we let our guard down and relax. And this is the challenge. This is what we, together, right, communally, the regulators, the sell side, the buy side, the service providers, we all together are basically trying to achieve today.
And I think, as we were just saying, one of the primary transactions across that industry, across all the participants, the collateral transformation trade, which, as you say, has been going on for years, but we're going to see, I think, significant volume increase in that, and important to this in providing liquidity across the market. I'd like to, I think I'm being indicated to bring this to a close, gentle close. I'd like to bring up our second and final audience question, and then we'll take Q&A. So the question here is, what do you think will become the most important provider of collateral transformation? Repo, stock borrow lend, both, so do you think they're becoming one market, or something else? Aha, 57% saying both, undifferentiated, single collateral transformation market. Very interesting, thank you. Any comments on that? And then we'll take audience Q&A.
I think, sorry, go ahead.
I think something new is also interesting. I heard this thought yesterday. If we were able to create sort of very liquid ETFs with high quality assets in there, and we were able to move those ETFs, so without actually going to go to the market, trade those bonds in and out all the time, but actually move a basket of those bonds.
So a GC ETF.
For example, yeah, and have the possibility to move that around. That would make it a lot more efficient, I think, and less dependent on all those market makers to buy and sell those assets all of the time, which is, I think, an interesting thought to discover further.
Any final comments?
Yeah, what I was going to say is that it's almost not important what will be the instrument of choice. As I said earlier, repo, sec lending, all these things are just tools. Okay, they happen to be the best tools we have come up with so far, but there is nothing to say that there will be no other tools. And by the way, a lot has to do, and a lot will depend with what direction the regulations take. Because, for example, certain instruments are on balance sheet and other instruments, certain trades executed through certain instruments are on balance sheet, and other trades executed through the same instruments, but in a different way, are off balance sheet. And also, some instruments have a better balance sheet treatment than others, on the whole. So the fact that we're having capital questions suddenly that are extremely hard-pressing for all of us are rising from use of balance sheet, which is a first. You know, it is do not underestimate how fundamental a change in the structure of the market and in the structure of bank balance sheets and all intermediaries' balance sheets this thing will bring. The fact that these questions have arisen, I think, will have an impact on how the market transacts. So we may well end up with different structures. I think the point we're making is that this transformation mechanism and the ability to not just transform but also move collateral around will remain in the system. It is important that it remain in the system. You heard it from a regulator, you heard it from the sell side, you've heard it from the buy side. I don't know how we can make it clearer. So it is important that it remains, and the instrument ultimately is less important. And I think we may well come up with new instruments and new ways of structures. You know, agency-type structures, for example, that so far have not taken off, but I can easily see a scenario because of the capital pressure arising through use of balance sheet, which will make them almost mandatory to develop in the very near future.
So David, we do need to bring it to an end. I think we could have carried on going. Thank you very much.
Have we got time for some Q&A, or?
I think we're going to stop it there. But if you do want to ask these guys any questions, you know who they are. Do go and see them afterwards. And we're about to go to coffee. Thank you very much to David Field and the panelists.